SN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. This is Kerry Lutz. It is Monday, September 8th? Yes.
It is already.
Yeah, and that's John Rubino of dollarcollapse.com. John has written an article that you really need to take a look at if you haven't already seen it on dollarcollapse.com, as he talks about something that you don't see really discussed much anymore. Certainly not by the Keynesians. That's something called real interest rates. His title of his article is Real Interest Rates and Future Chaos. What is a real interest rate? That is the rate of interest that you pay to borrow money less the rate of inflation, whatever that is. That gives you your real interest rate. And, well, I'll let you explain it from there, John.
Hey, Kerry. Yeah, this is a fascinating chart. I actually spent about an hour just looking at this thing. It's from a website called Gresham's Law, and it's an interactive chart of real interest rates since the 1960s. And it's fascinating. I really didn't know the relationship between real interest rates and the overall economy was as ironclad as it seems to be here. So basically, the real interest rate, as you said, Kerry, is the rate on a loan that you take out. Adjusted for the rate at which the currency that you're paying back is being depreciated. It's going down in value. That changes the real cost of your loan. So in periods of high inflation, then real interest rates can be kind of low because you're paying back much cheaper currency over time. And so your loan is actually less expensive in real terms than it seems just by looking at the number. So based on this chart, it looks like real interest rates were nice and stable during the 1960s. In other words, it was slightly positive. It cost you a little bit to borrow money. That's the rental cost of money, basically. And it cost maybe more or less the same year after year to borrow money, which is a sign that the economy is fairly stable and understandable. You know what you're getting when you make a loan and when you take out a loan. And then in 1971, we break the final link between the dollar and gold, and interest rates, real interest rates, just go crazy. They plunge to negative levels in 1975 and spike in 1980. And what this means is that in periods of negative interest rates, in other words, when you're being paid to borrow, because the currency is being devalued at a rate that exceeds the interest rate you have to pay. The system is encouraging you to borrow as much money as possible because money is not just free, it's actually negative. It has a negative expense. They're paying you to borrow. And so people tend to borrow huge amounts of money and do basically unwise things with it because it's free. When something is free, you tend to do stupid stuff with it because you don't feel like it costs you anything. And then when real interest rates are very high, that's a sign that you shouldn't be borrowing and you should be lending money because you get this really nice real rate of return from lending. And so you would expect the economy to contract because interest rates are high, money's expensive, and fewer loans are taken out. People don't want to borrow at these high prices, so you get a big recession. And that's what this chart shows, that in the 1970s we had a currency crisis because too much money was being borrowed, and then the system kind of tanked in early 1980s. In 1982 we had a nasty recession, the worst recession since the Great Depression. Now, since then, we've had interest rates, real interest rates, gyrate wildly because we've got just a government with a printing press, no link to gold, no control on how much money they could create. So you get wide swings in real interest rates. And they coincide with the booms and the busts that we've seen here. In the mid-1990s, real interest rates dropped to about zero, and that set off the tech stock bubble. And then in the middle of the previous decade here, the early 2000s, interest rates went negative again, and that set off the housing bubble, each of which bubble led to a horrendous crash afterwards. And then after the crisis of 2008, interest rates have gone negative and stayed mostly negative since then, which explains all the asset bubbles around the world right now. We've got an equity bubble going on, and bonds are at at record high prices, record low interest rates, and the emerging markets are seeing equity bubbles, and trophy real estate is through the roof, and fine art and farmland. We've got all these asset bubbles, and they are explained by negative real interest rates. So what does this mean? This means that these bubbles are at some point going to burst like the previous bubbles, and real interest rates are going to spike, either because nominal interest rates go up around the world as people get more and more nervous about lending money, or we have a deflationary scare where the value of the currency starts to go way up in whatever currency you happen to be borrowing and lending. And that causes interest rates to go negative or to go sharply positive. Either way, historically, these wild gyrations in real interest rates always lead to the opposite taking place. So extremely negative interest rates today are going to lead to extremely positive interest rates and some kind of a financial crisis in the future. And this chart makes that abundantly clear. And based on the chart, we are not really in any kind of radically different situation right now. We're just doing what we did the last three cycles. The last three asset bubbles had negative interest rates as their starting point, and we're back again. So if history is any guide, the next few years are going to be increasingly chaotic with an increasing tendency to positive and extremely positive high interest rates, and then some kind of a crash out there. So that's why I found this chart so fascinating, because it gives some structure to the sense that you and I and other people in the sound money community have had, that we were creating the conditions for some kind of new catastrophic year or two, that is even more extreme than 2008, 2009, because we're creating so much new currency. Well, now you can see it visually. So I recommend that, anybody who's interested in the subject, take a look at this chart, either on dollarclaps.com or at Gresham's Law to see the original interactive version. And from it, you'll conclude that we're headed for serious trouble.
And in other words, there's really nothing new under the sun here. It's just the extremes here, John. I mean, we've got, when you look at this chart that the guys at Gresham's Law so gratuitously put together here, you see that what we're going through now, we haven't seen anything like it really since 1980, since 1975, and the results there were catastrophic. But the one thing you didn't mention is that they changed the definition of inflation, or effectively changed what inflation was all about, because they put all these adjustments into inflation and have effectively cut the reported rate substantially, because you'd have to go look at shadow stats to get the real inflation rate as it was reported in 75 and 80. And if you did that, you'd see that it's underreported by 2 to 3%. So add 2 to 3% to the minus 2.5 that we see now, and it's even worse perhaps than it was in 80 and 75, right?
Yeah, Kerry, thanks for remembering that. If we were calculating inflation the same way today as back then, this chart would be even more extreme. Yeah, we actually have much more negative interest rates right now than we had in the 1970s. And which isn't a surprise, since we've got so much more debt now that we've got to deal with, so it's so much more necessary for the world's central banks to push interest rates down in order to make this debt manageable. So yeah, we're in an even more extreme situation than we were back then. And so while the chart looks similar right now, today's world in the 1970s looks similar on this kind of a chart, today is actually much more extreme, and therefore leading to a much bigger potential crisis. Because, the negative interest rates of the housing bubble are nothing compared to today's negative interest rates, which means that the incentives to malinvest, to borrow huge amounts of money and invest it in stuff that probably shouldn't be done, those incentives are bigger today than they've ever been. So that's why you see so much money flowing into real assets out there, because for somebody who understands, the smart money out there, the 1%, they get that borrowing money today is an incredibly good deal. because interest rates are actually extremely low to the point where they're being paid to borrow this money. And so they're taking that money and they're putting it into real stuff. They're buying fine art that can't be created by a government on a printing press, and farmland, of which there's a limited amount, and trophy real estate. There are only so many London penthouses in the world, and it's very hard to create more of them. And so those things, because they exist in limited supply, while the currency that you're borrowing is just being created, just shoveled out the door by these central banks around the world, it's a great deal to borrow huge amounts of money and put it into these real assets. And you would expect that based on the numbers, and that's exactly what you're seeing. The people of the world who are very rich and therefore either understand finance or can hire people to explain finance to them are doing this around the world, and it makes complete sense that they're doing it. For the rest of us, it leaves us in a situation where our jobs are at risk, and who knows what's going to happen to our house and our community and everything, because the world is getting more and more unstable, and we're heading for an even bigger crisis. So the one thing that is easy for the average individual to buy is gold and silver, and that's something that tends to go up in times like this, and it hasn't lately. And, we can spend a whole show another time talking about the reasons why gold and silver haven't soared along with farmland and oil wells and fine art. But I think that's a reversion to the mean issue, where they're going to go up at some point as much as these other assets that exist in limited supply. And so in response to extremely negative interest rates, gold and silver are probably the thing that you want to be buying right now. And very few other things, especially financial assets, do well in the swing to positive real interest rates that we're going to see at some point in the not too distant future. So, office buildings in mid-range markets and the typical McMansion in the U.S., things like that, they probably won't do so well when real interest rates go up. But precious metals in the past have tended to do well in that kind of a crisis, because that's where people go when they're scared.
Yep.
And people will be very, very scared when all of this hits the fan. And in 2008, you saw the system almost spin out of control, almost totally collapse around the world. And precious metals went down briefly and then soared afterwards when the central banks of the world responded by printing even more currency. And we'll see the same thing again here when real interest rates start to go up, and that starts to choke off economic growth around the world. Then you'll see what basically around the world, what's happening in Europe right now, where things start to slow down and the central bank just comes out and says, look, we'll do anything. It doesn't matter what it takes. We will do it. So relax. You need 20 trillion extra euro. Okay, you got it. Whatever. We'll buy back all the asset-backed bonds in the market. That's what they're saying now to the marketplace in the hopes of calming down investors and savers in France and Spain and Portugal, and getting them to start spending money again. And so you'll see the central banks of the world do that again when interest rates go up. And that will be great for the assets that people flow into when they're nervous, and precious metals are probably the best example of that around the world.
Yeah, I couldn't agree with you more, John. And basically, they're saying, "Don't worry, nothing can go wrong." And you and I know that everything can go wrong. It's just a matter of time till it goes wrong. And hey, and then when it goes wrong, what are they going to say then, John?
Well, they're going to keep saying the same thing they're saying now until they do something like that and it doesn't work. And then they'll have nothing left to say, because they only have the one tool now, which is forcing interest rates down and creating as much new currency as possible and just flooding the banking system with it. That's all they've got. So later, when it doesn't work and everybody loses faith in these central banks that we think of as the adult supervision of the markets now, the smartest guys in the world with the best tools, and they will fix things if anything needs fixing. And once we realize that the stuff they just told us turned out to be completely wrong, and therefore maybe they never knew what they were talking about to begin with, then who knows? Then all bets are off, because that's the only thing that supports today's currencies is our faith in the willingness and the ability of the guys running the show to keep a lid on trouble and to keep growth going and to maintain low inflation and all the rest. Basically to keep normal life going as it has been in the past. And once they show us that they can't do that anymore, then who knows? Austrian crack-up boom, as you and I mention almost every time we talk is one very reasonable scenario where everybody just gives up on the currencies. And they emulate today's rich people and start buying real stuff. Every time they get paid, they buy the necessities of life at any price. Or if they have any extra money, they buy farmland or gold and silver or other things that they realize governments can't just create more of. And so you get all the world's capital flowing out of financial assets and into real assets. And that means the price of real assets goes through the roof in a way that can't be hidden by the government. And the system just breaks down. Nobody wants to hold the currencies anymore. They plunge in value. And then you get a period of chaos until somebody resets the system with sound currency. That's what happened in Weimar Germany in the 1920s. They had a hyperinflation that lasted like 3 years only. It was just overnight from the standpoint of economic history, where the currency was functioning, and then 3 years later it was toilet paper, if even. They were burning German marks to keep warm at the height of the hyperinflation, and then they instituted sound money backed by real assets, and it stopped, and normal life returned, except normal life minus the savings of all the people who had seen their savings wiped out by the currency cratering previously. And we'll see something like that again here. Who knows what form it takes, but we have to go through that process of realizing that these currencies are being mismanaged, giving up on them, and then setting up something that works better at the end. And that's going to be chaotic for the average person. It's going to be impossible to understand and incredibly threatening, and hopefully won't lead to everybody being willing to accept a dictatorship in order to keep a lid on things. But you never know. That's the way really serious currency crises have gone in the past. You get a huge crisis and then you end up with a dictatorship because people are just willing to accept anything from somebody who promises to be a strong leader and promises to stop the bleeding. And we're already kind of tending towards that right now, where especially in the U.S., we're willing to accept incredible things from our government in order to protect us. We're trading freedom for security right now at a really terrifying rate. And that's before the financial system spins out of control. So who knows what happens then? And all you can say with certainty is we've got some volatility ahead of us, and possibly chaos. And we'll come out of it at the other end a very different society than we go in. And hopefully the difference is a positive difference, but you never know. History isn't really reassuring on that count.
Yeah, it's really frightening. And, it's not like it's never happened before in other societies. Like you mentioned, a couple is also France around the time of the revolution, right? Happened there.
Well, in that century, France destroyed their currency twice. Mm-hmm. And the second time was with the French Revolution, when they deposed their king, put a new government into place, and that government immediately started creating huge amounts of new currency. They actually did print new currency back then. Today we use that as a shorthand for electronic funds transfers. But back then they ran the printing presses until their currency was destroyed. They had a couple of years of chaos, and then Napoleon took over. So they got themselves a dictator who then started a series of European wars, and you had a decade of nonstop fighting in Europe. So, like I said, history isn't really encouraging when you look at financial crises and what comes after. But maybe we'll get it right this time. Maybe we'll educate ourselves, and we'll come to understand what's happening before we get to the point of saying, just, do whatever you have to do. We don't care about the Constitution, and we install a limited government with sound money that has a respect for individual freedoms, and then we start over from there. And that's the real argument when the time comes. Because right now politics don't much matter. We've got this institutional momentum that's taking us off this cliff. But when we go off the cliff, then we're going to have to debate what to create from the rubble. And we have a chance to argue for a return to constitutional principles. of sound money and limited government and individual freedom. And we have a chance of winning that argument. It won't be easy because there will be a lot of people wanting very different things. But to the extent that the sound money community gets educated and articulate about these things, we at least have a chance of coming out on the side that wins this argument in the end.
Right. If there's actually a debate, but the state of political debate in America, John, today, it's non-existent. There is no what you would call intellectual debate. It's all propaganda. It's all, gobbledygook. Nobody ever really debates what's good for the country, what's good for you, what's good for me. It's never presented in that way, No. Well, it's because we've reached the point where there aren't any solutions on the spectrum of what's possible that will get you elected. You can't be Ron Paul and talk about calling home all the soldiers and closing down all the foreign military bases and scaling back the entitlement state. You can't do that and get elected because we haven't come to the conclusion that those things don't work yet. So it really doesn't matter who gets elected. You end up with basically the same kind of leadership. Bush was obviously borderline crazy and was an incredibly bad president. But then we elect Barack Obama. What do we get? Yeah.
And he ends up doing a lot of the same things. He actually stepped up the surveillance state. If you read Glenn Greenwald's new book or any of his magazine articles of the recent past, you see that Bush started the whole surveillance state and Obama took it to a whole new level. It's much more extreme and invasive now than it was. And so, if you elect a liberal Democrat constitutional law professor who runs on a platform of respecting individual privacy, and you get a stepped up in surveillance state, what does that mean? That means it doesn't matter who you vote for. You're going to get basically the same stuff. The government is going to continue to borrow more and more money. The military establishment is going to continue to grow. We're going to continue to invade people around the world with impunity. And the blowback from that process is going to get bigger and bigger. We're going to make more and more enemies. The financial system is going to get more and more fragile until it all breaks down. It could be a geopolitical thing that causes it. It could be a banking crisis. We haven't even talked about derivatives yet, which is this huge time bomb that's out there that nobody understands and nobody really reports on effectively. And so many things could happen because we've let all of these processes run to their logical extremes. And there's a limit to how much further. They're illogical extremes. And there's a limit to how much further they can go. So when something hits a wall here, whether it's a geopolitical situation that we just can't deal with and we have to admit that we're impotent in the world, or a financial crisis where it's so big that even a central bank with an unlimited printing press can't fix it, or a currency crisis where turns out there's no tools left to stop a plunging currency. And because we can't raise interest rates like we did in the 1980s, or that would destroy the leveraged speculating community and most of the rest of the financial system. So one of those things will happen.
Exactly.
And we'll realize that it's basically over for this system. But until that time, it is over for us. So find John's work over at dollarcollapse.com, buy his book, The Money Bubble. And don't forget, go over to financialsurvivalnetwork.com, check out our work. We're finding articles for you all over the internet, trying to get you the truth about what's going on here, as John has been so adroitly explaining to you during this interview. And don't forget, sign up for a newsletter. John, we'll talk to you next week. Thanks, Kerry. See ya.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.